taking into account someone's tax situation is very important when you're investing, because we don't eat before tax returns, we actually consume after tax returns. And for most Australians, we have to pay tax. So actually analysing or making decisions from an after-tax perspective is very important. And it's highlighted in this chart. And this chart isn't a chart of the tax rates, it's actually the chart of the after-tax value of $1 of pre-tax income. And we've plotted it for 3 different tax situations. We've plotted it for, firstly, zero tax investors, which would be the first $1.7 million in pension phase superannuation, or for charities, or people who have very low income and don't pay tax. Then we've plotted the same for a 15% tax rate, which is the tax rate for accumulation-based super. And then lastly, we looked at it from the highest marginal personal tax rate. And you can actually see that the after-tax value of income is different for these 3 different types of investors. And it's one reason why we actually have a strategy which is targeted for pension phase super, because it's taxed differently to other types of investors. And you can clearly see on this chart the value of franking credits, because $1 of fully franked dividend is actually worth, if you get paid a $1 cash dividend, it's actually worth $1.43, because you get a 43-cent tax credit when you put your tax return in at the end of the year. So for those investors, the only way they can improve their after-tax income is to get more franking credits. At 15% super, the pattern's somewhat similar in that the fully franked dividend is still worth the most, but it's not worth as much because you are actually taxed at 15%, so it's only worth $1.21 after tax. But that's still substantially more than other forms of income, such as rental income or interest income, which has no franking credits, and short-term capital gains, which are both taxed at 15%. And it's substantially better even than a long-term capital gain, because in superannuation you're taxed at 10%. So if you've got a $1 long-term capital gain, it's actually only worth 90 cents in the dollar. Interestingly though, if you flip it around and you go to the very right hand and you look at the high tax investors, someone paying 45 cents in the dollar plus 2 cents Medicare, the actual best way for you to maximise your after-tax income is to receive your income as a long-term capital gain. And it's even better to actually forestall realising that gain for as long as possible, because you don't have to pay tax to actually realise the gain. And that's why many investors argue you should have low turnover strategies, because you want to get a lot of capital gains and long-term capital gains. But the interesting thing is, for pension phase investors, they don't pay tax at all, so capital gains tax is irrelevant for them. And that's why you have to manage, technically you should manage strategies for each particular tax group. And that's why here at Plato, we've established strategies for the zero tax end of the market, because we see that not many people actually manage for those investors, and yet they're the investors that are most reliant on the income from their investments to live off.